Welcome back to another video. I'm going to go over selling put options for income and why I love doing it so much. So we're going to hit the bottom left corner, watch list, and then in the top right corner, we have a magnifying glass. But before I get into it, remember, this is not financial advice. I'm not a financial advisor. And I'm going to use the example SLV. SLV is there it is. This is a iShares Silver Trust ETF. It is just an ETF that basically tracks the spot price of silver. So for example, if you're bullish on silver and you want to turn that into an income producing asset, you can sell puts against SLV. It's a great strategy. I love it. And let's get right into it. So when you sell a put, that is a bullish play. And it might sound confusing because selling puts is called short. So when you sell a put, it's called a short put. So long puts are when you buy them, and short puts are when you sell them. So when you short a put option, it sounds confusing. It sounds like you're shorting a stock, but you're not. So selling a put or a short put is a bullish play. Now let me explain. The person on the other end of that trade, they're buying the put. They're long the put. And when you buy a put, it's a bearish play. You want your stock, you want your underlying ETF or stock to go down when you buy a put. And then when you're buying the put, you pay the premium. And so when you sell the put, you're the one who's collecting the premium. You get paid the premium. You just are now on the hook for those shares if they expire in the money. So for example, if we click on SLV, and then here we have the options chain. We have the chart, the news, and the options chain. And then right here, all the way to the left, we can click what expiration date we want. So we're going to go, let's do September 17th. So we're going to click that. Oh, I need to mention that SLV is trading at 22 cents. I'm sorry, $22.27. So let's look at the strike prices, which are the numbers in the middle. And we want to be below our strike. We want to be below the current price of the stock. And in this case, it'll be $22. So we'll click there. On the right side, we have puts. Then we'll click here, sell. And this is the number of the quantity. We'll just click one for now, one contract. We'll sell one put option. The bid ask is 17 cents, 19 cents. So we'll do 18 cents. So what this option is saying is you will collect $17.60. That is after the commission is taken out. In premium. It's called a premium. This is cash that you get paid immediately. You get it paid up front. But until expiration, you are on the hook for buying 100 shares, or not buying, but being assigned 100 shares of SLV at $22 per share. So let's click review, and this highlighted area in red, that is the order. So it says sell to open. Under that means to open a new position. So we're selling to open this position. -1, the minus stands for selling, so it's short 1 SLV 100. 17 September 21, that's the expiration date. September 17, 2021. 22 is the strike. Put, so we're selling a put at 18 cents. LMT just means limit. It's a limit order. So if I send this, if the market was open and trading right now, because options don't trade after hours, they trade during normal market hours. If I were to click send, this would fill. I would get paid $18, and I would just want SLV to stay above $22 a share by September 17, 2021. If SLV stays above $22 a share by that expiration date, the option will expire worthless, and I get to pocket that $18 and move along with my life. Now, if you were to do 10, boom, that's $176. And imagine doing that weekly, and you could do this with like 10 different stocks at the same time, and there's so many different types of strategies that you can do. One of my favorites is called a short strangle. That's when you own 100 shares. I wasn't going to get into it in this video, but where's GSK? I recently had one. I think it's here at the bottom. I had a short strangle. Actually, yeah, I do have a short strangle here right now. It's a perfect example. So I own 100 shares of GSK. Now this video is going to be longer. So if you're interested, remember, this is a short strangle that I'm talking about. No longer talking about just selling a naked put anymore. So I have 100 shares of GSK, and a short strangle is when you sell a call and you sell a put. So your put will be below the current price, and your call will be above your trade price. So or ideally. So here, this one on the top, I have a $42 call. That means that by September 10th, which is tomorrow, if GSK it goes past $42 a share, then I will lose or sell. I will be assigned, and my 100 shares will be sold at $42 per share. That's why I said you want your short call, and this is also called a covered call. That's the name for selling a call. If you didn't have 100 shares, it would be a naked call. You're selling a naked call, but since we have 100 shares, we're covered to sell our 100 shares if the stock goes past the strike price. But as you can see, my trade price was 25 cents, and then I sold one, so I collected $25 in premium. And it looks like this is going to expire worthless. So tomorrow, GSK is most likely going to be under $42 per share. This will be expire worthless, and I made $25 off this trade. Then I also have my short put, which is, as you can see, it expires not tomorrow, but a week from tomorrow, September 17, 2021. This has a $39 strike price. Currently, we are 39.78. So what this is saying is if GSK goes below $39 a share by next Friday, I will buy an additional 100 shares of GSK at $39 a share. And I got paid $15 to sell this put. It's not that much money, but it's still money. This is a very defensive stock. It's not volatile at all. It's a low PE, high dividend, large cap stock. Kind of just trades sideways. It's like a dividend paying stock. So it's not a volatile stock at all. It trades sideways for the most part. It was down a lot today. It's a pretty big move for GSK usually, but European stocks sold off pretty bad due to the ECB. I think they said they're going to reduce their asset purchase program, which is bad for stocks. Anyways, that is a short strangle. So I have a short put, meaning I sold a put, collected a premium, and it wouldn't be so bad. If GSK went below 39, I wouldn't mind it. I like the stock. It pays a 5% dividend. And remember, when you sell a put, you have to not mind owning those shares. So if there's a stock you really, really like and you're bullish on it and you don't mind if you did own it, then selling puts is an awesome strategy. And that's what I'm doing with GSK. I'm selling one contract and collecting $50. It's not much money, but I also sold my call for $25, so that's $40 right there I made off GSK. And like I said, it pays a 5% dividend. And if it goes below 39, I'm going to buy even more shares. And once I have even more shares, I'm going to sell even more covered calls. So I turn this stock into a cash generating machine. It pays a dividend. I'm selling puts, I'm selling calls, just collecting a bunch of cash. Like I said, you can turn a portfolio into a cash generating machine. So that's it for now, guys. I'm going to wrap it up. This was selling puts and a short strangle as a bonus. So I hope you guys enjoyed this. If you got value out of it, I really appreciate you. Smash the like button, leave a comment, and subscribe to my channel. I'll see you guys in the next one. Thank you. Bye.